There we go. All right. So that being said, Yonah, welcome to the Gaithersburg Apartment Building Investors Meetup for June.
Thank you. What an introduction, Brian. It's a pleasure to be on with you, and everyone. I see a lot of familiar faces and names, so a lot of not so familiar faces and names. So pleasure to meet all you guys, and appreciate the kind words. It's been a journey, you know.
Well, I could have gone longer with the introduction, but for the sake of time, you know, we stopped it right there. So Yonah, why don't you tell everybody a little bit about your background? You know, maybe a little where you grew up, you know, where you're from, and you know, what got you into the commercial real estate business?
Sure, pleasure. So I actually grew up in Southern California. I went to San Diego State University, and which I think we had some, I recall we had some sort of connection with that too, Brian.
My wife graduated from San Diego State University, and I was faculty there for 3 years. So we did have a connection there. Okay. I think that may have been the first thing that I noticed on your profile was the SDSU thing.
Could be. It kind of stands out. It's a little bit of an incongruence, you know. There's not people look like me going to San Diego State University. That's for sure.
Beautiful school, beautiful campus. I mean, I don't know how kids graduate and get a degree living in San Diego, but
most
a lot of them
I think
still
the
do.
average you know, tenure is about 6 or 7 year undergrad.
Yep.
But something like that.
Doesn't surprise me.
But no, so I actually spent about 15 years or so after graduating from college, and I didn't really know what I wanted to do at that time. And I even to a certain extent still don't. But I, was in teaching, and I was studying full time and teaching, and just kind of getting that was kind of my passion, and that has continued. I have a beautiful family, 6 children, and it's something that's kind of led me throughout my life. Just this part of me is just, I love to teach. I love to help other people. I love to give over. And I have a unique kind of ability to take some very complex ideas and, share them and give them over to simplify them. So that's kind of my background. About 5 years ago or so, I got, and I'm dating myself to do the math, but 5 years ago, I got into to real estate, kind of just looking for something more, something different. Started in the commercial mortgage side, and did that for about a year or so, and literally just wanted to learn everything there was about the real estate. Got bigger pockets, and then I got a real estate broker's license and residential, did a few fix and flips. And one thing led to another, and I don't even remember exactly how it happened, but I found this company I work for currently, Madison, commercial real estate. So they have a number of services all within the commercial real estate industry. So the Segregation, we're one of the largest national companies doing this. We're commercial title agency, 1031s, all kinds of other services, very niche, unique services for commercial real estate. And I wanted to kind of get into this company because they had such a broad reach across the whole country in so many different aspects. And by doing so, I found I was able to network with so many people across the country in real estate, in multifamily, and kind of fell in love with that of my, from my own standpoint. So while doing the Segregation and kind of teaching people and being on podcasts and, like you said, the LinkedIn and the social media, and it just kind of allowed me to branch out across the country to people like yourself and you guys in this group, and speaking at other groups. And I love real estate. And so I'm just passionate about helping people. Number one, obviously what I do is help people save taxes, right? Which you know all that. But number two, just educate people further and network. And that's really kind of become my forte of just bringing people together, like you're doing here with this group, and you're doing it locally. But with the current situation, it kind of allows us to branch out much further and bring in people who aren't necessarily local. And so I facilitated that, like with the podcast I'm doing, and with this also virtual meetup, which I actually got the idea from you. I was on yours a couple months ago, and I was like, hey, this seems pretty cool. I'm going to do it myself. And I literally started one. And
it's kind of necessity is the mother of invention. I had no idea that Zoom had breakout rooms until everything closed down for COVID, and I was disappointed because I had my first meetup set for April, and I'm like, how am I still going to do it? But, lo and behold, after, clicking through a bunch of YouTube videos on Zoom, there it was. I'm like, perfect idea.
So
I'm
cool.
totally going to do that. But yeah. And what I've noticed, and I'm a little jealous, is, every time you post screenshots of your meetups, there's a lot more people than I get. But we'll get there. We'll get there.
You can join also, Brian.
I will. I haven't yet because of scheduling, but I'm going to be on there as soon as I can.
That's awesome. It's just another avenue to bring value to people, and it's another avenue to kind of bring people together.
Yep.
And like I said, it's kind of what I've found, has been doing. And it's not like it's always been like that. I've been doing this I did webinars for a while last year. I was doing like a weekly webinar, right? And trying to, kind of educate people on cost segregation. And I literally, my goal was to get, every week and to get at least 10 people to a webinar. And I had some that had over 100 people, but I remember one, I got there and there was one person on the webinar, right? But I still did it with, the same energy and the same, education as if there was, it was a room full of people. And that really that's something that I learned as a teacher, is that you have to be teaching, you have to be focusing on just, one person. And if you're focused on one person, it doesn't matter if there's 100 people there or 1,000 people there. But again, when you have that focus, you just care about that one person, make sure that one person understands, you can accomplish a lot more. And it comes across.
Yeah. I mean, sincerity, that's one thing that I've definitely noticed about you. You're always sincere, and you're always looking to help people. So, I mean, just for everyone else in the group, I mean, he's not just saying it, he practices it. But so speaking of teaching and cost segregation, why don't we start out with that subject, and then once we've got a pretty good understanding, we can move on to maybe some LinkedIn, some grow your business through social media tips. So first of all, let's talk about cost segregation and taxes, which is usually a word people don't want to hear.
Yeah, it's not just that people don't want to hear it. It's like we have a little bit of almost a deterrent to taxes. When we hear taxes, we just want to like, okay, my accountant deals with that. Like, I don't want to even know about it, right? Because it's complicated, and sometimes it's things that are just kind of beyond us. But what I like to do is just kind of focus on some things that we can understand, some things that we can get control of. And you know what? It's important to have an accountant. It's important to have a tax advisor that you can rely on, that they are doing the work. You don't have to kill yourself to learn the whole thing. Cost segregation is just one tiny little bit of the tax code. And it's one tiny bit, but it can make a huge difference, especially if you're a real estate professional. Yep. And it's something that we can talk about and get into a little bit more what defines that and why that's so important. So even to understand cost segregation, we have to understand what depreciation is. And I think if you own real estate, you probably know that you get this tax deduction called depreciation, but it doesn't mean that something's going down in value, even though that's what the word means, right? Something's going down in value. The IRS gives you a tax deduction when you buy a building based on the purchase price of that building. So if you buy a building for $1 million, a little bit has to be allocated to land, but now you get to actually literally take a tax write-off, okay, income tax deduction of the entire value of that building. Yeah. Okay, now you can't do all that in 1 year.
Yeah. My understanding is it's based off the fact that things over time lose value. Like if you bought a truck or a computer or something like that,
absolutely.
The IRS gives you depreciation because it loses value over time.
Correct. So that's the concept. And the concept is that everything has a useful life. Okay, and you're absolutely right with a truck or with equipment. It definitely has a useful life, right? You buy a printer, you have to buy a new printer every 5 years or whatever. You buy a car, it's going to go down in value, and you know that the minute that you drive that car off the lot, it goes down in value. However, the reason why I say it's just a borrowed term when it comes to real estate is for two reasons. Number one, when you buy your property, real estate is one of the only things in the world that has a natural appreciation, meaning that as time goes on, it is naturally, without any other outside factors, it's actually going up in value, which there's almost nothing like that in the world.
Yeah.
So to give you a tax deduction that the property is going down in value when in fact it's intrinsically going up in value, that's the first thing. The second thing is that it's not intrinsic to the property because it starts the schedule, that timeline that you can now write off the property for commercial properties over a 39-year schedule, and for residential and multifamily property over 27.5-year schedule. That timeline starts when you buy the property. Mm-hmm. So it's not intrinsic to the building. If it were, then if you bought a building that was built 30 years ago, then it no longer has any value to it that you can take that tax deduction. But depreciation literally starts over that schedule that you can write off from the day that you purchase that when you place it in service. Okay, so that's in a nutshell what depreciation is. So again, you buy a building, you can write off the entire value over a certain period of time. Okay, and you get a tax deduction a little bit every year.
So yeah, every year a little bit of that money offsets your income is basically how it works out most of the time.
Exactly. So let's say you buy a building for $1 million and your net operating income is, let's say, $70,000, right? So you would get, right off the bat, you write off that purchase price. Now you get that basis, whatever's left over, you divide that by 27.5 years. Mm-hmm. Okay. That means you get approximately $30,000 a year as an income tax deduction on that $70,000 of income. So you made $70,000. Now you subtract immediately because of depreciation, $30,000. You're only left to pay tax on the remaining $40,000. That's in a nutshell what depreciation is and how amazing it is. For no reason other than you bought this investment property. Okay, it doesn't apply to your personal residence, but any type of business property, yeah, you can get this deduction. Now, where cost segregation comes into play is just like an advanced form of depreciation. So the IRS, besides for the property itself having a 27.5-year life, they said, no. That's just really the structural components of the building, right? So like the roof and the doors and the windows and things that are integral to the actual structure of the property that you can't live without. So that has the majority of the value, but there's a lot of things in a property that actually have a shorter useful life. So personal property, if you think about something in a building like furniture, appliances, fixtures, right? Shelving, cabinets, all the kind of stuff that you actually have to replace it, right? The carpeting, okay? You actually have to replace that at a faster rate. So the IRS says these things have a much faster depreciation schedule, which means if you can find the value of those things, you can take a tax write-off at a much faster rate. Okay, so on all those things I mentioned before, that personal property, that stuff that's movable, they depreciate on a 5-year schedule, which means you can identify the value, and this is actually the process of cost segregation, is like take the cost, okay, and segregate it, okay, not segregation, but putting into components, right, saying the car, all this stuff is on a 5-year schedule, and all this stuff is on a 15-year schedule. That's the land improvement stuff that's outside the building. So when you come up with those values, now you can actually take faster, or in other words, take bigger tax deductions in the earlier years.
Yeah. Now, in the case of a lot of multifamily, especially syndications, most of the investment lifetimes are 5, 6, 7 years. So what that does is basically the time that you own the property, you're depreciating a whole lot of money over that time period. Yeah. So you take it all up front, and by the time it's depreciated down, you're about ready to exit. Now let's talk a little bit about the backside, because it's not all roses. What happens when you sell a property that's been depreciated?
Yeah, absolutely. So when you go to sell a property, now again, before I even get to what happens when you sell a property, I have to understand what the value of this. What's the value of putting front loading all these deductions? Okay, because in our example, we had $1 million building that we got a $70,000 net operating income, right? And we got a $30,000 deduction. But now creating cost segregation, creating more deductions earlier on, we're probably in the first 5 years going to have all that income with very little to no income tax liability, which means we're going to have more deductions than we have income.
Right.
So creating more deduction of income, that means all of that money creates cash flow. Okay, and so you are allowing yourself to make that money and keep that money, reinvest that. So the time value of money is really more than anything else. Why this is so important.
Right. So, I mean, and my experience, you know, with depreciating real estate in general is even with cash flowing properties, almost every year with a cash flowing property, I've ended up with a negative number on my taxes, you know? So, I mean, there's a reason why Donald Trump says that, you know, he doesn't pay taxes, and, you know, you're smart by not paying taxes. You know, you're able to set things up properly, you know, set income streams up properly where you're not paying a whole lot of taxes on it.
Right, and it's really about the strategy of it, and it's important that you brought up what happens when you sell a property, because it has to be part of your overall business plan. And so when you sell a building, you have two things that happen. Okay, one thing is called capital gains tax. Right, there's two taxes that hit you when you sell a property. Right, you don't get all. It's not all fun and game, not all roses. When you sell it, you get capital gains tax. So if you made money on the sale, you actually have to pay a tax on that gain, capital gains. When another tax you're hit with is called Depreciation Recapture Tax, okay? And this is taxed at actually two different rates. But what happens is that the amount of depreciation that you took during the hold of that period, so in your example, let's say you held it for 5 to 7 years, you now have to pay a tax on the amount of depreciation that you took, okay? So that has to factor in on the sale of the property also. So you took all this depreciation upfront, right? You front loaded it during those 5 years, right? You may have paid zero to no taxes, right? Little to no taxes. Now, when you sell a property, you're going to have to factor in what happens with this depreciation capture tax. You have two rates. Number one is 25%, capped at 25%, which is basically anything of the components of the building. That's the main structure, which is the majority of the depreciation. Okay, and then you have personal property, which actually gets taxed at a higher rate. Okay, that's going to be taxed at ordinary rates. However, you know, and that's all going into factoring upon the sale. Now, there's a couple of ways that, you know, all things being equal, if we're in a bubble and we're just thinking about one property, let's say you're a one property guy or gal, okay, and you buy this property and you hold it for 5 years and then you sell it and that's it. You didn't buy anything else in between. The point we're making here is that you have to consider the tax, you know, what I would have paid now had I paid the tax up front and not taken all that depreciation versus what I'm going to have to pay 5 years from now. So there's always going to be an arbitrage of your savings over that 5 year period. Okay, not just the time value of money, but actually paying less tax because you took the money now versus, you know, taking it later on. So it's like borrowing money from yourself later on. Yeah, that's kind of how I look like. Some people like to look at it like an interest-free loan from the IRS, but I like to look at it like it's actually an interest-free loan from your future self. Right. Okay, because you are going to have to pay taxes later on it anyways, but I'm taking that money now as deductions so that I don't have to pay taxes now. Later, I'll deal with it. And when I say deal with it, is because you have to, you know, not everything's in a bubble, right? Tax is not in a bubble. Real estate's not in this little box because oftentimes you'll have more than one investment, right? You may buy one property this year, right? Like you guys, for capital, you guys are, you know, bought a property this year, bought another one, you know, you're probably going to buy more next year, probably more this year. So all of these come together in, you know, an overall picture. And so what happens then is the depreciation from one property can actually be used against the income from your other properties.
So,
okay?
you're saying if you take your, you know, maybe you take your proceeds and you put it into another property and you use accelerated depreciation again, you can actually offset your taxes from your capital gains and your depreciation recapture.
Bingo. Exactly. And this is done, you know, if you're, and we touched on this a few minutes ago, if you're a real estate professional. Okay, so if you're a real estate professional, this is really where you can get the most bang for your buck. But, you know, it's going to have to be, and again, I'm not your tax advisor, not your, you know, CPA. This is something you're going to have to discuss with them, but this is something that you have to understand. There are, like you said, Trump, you know, whether you like him or not, he's not paying income tax, right?
Oh.
Why? Because he's smart. And it's about using the tax code to, it's a game. And, the incentives that are in there in real estate is one of the biggest ones. You have to use it. You have to use that tax code to your benefit. And this is one of the best ways to do it. But again, you have to plan accordingly. Okay, think about what's going to happen 5 years from now. What's the taxes going to be there? Can I then buy a property then, which I'm going to have bonus depreciation, which we'll talk about. I see someone in the notes in the chat over here asked about bonus depreciation. And I can get so much more deductions that can then go ahead and offset the gain, the recapture tax, etc., which is going to make life, as an overall game plan, right, on the long period, it's not just about one property, okay? It's not just about I'm buying this one and what happens to the property now and so. It's about your overall strategy, your overall plan, how to not pay taxes every year, right? As much as possible going forward.
Yeah. So I mean, in a nutshell, you're paying less taxes now. And if you do pay capital gains or depreciation taxes later, you're also taxed at a lower rate. Most people, I'm in a tax bracket above 25%, okay? And most people are, I would assume, that are on this call. But, when you pay taxes later, you said you're capped at 25%, so you're going to pay a smaller marginal rate, plus you're putting it off for 3, 5, or 7 years. And then if you do things right and you have another property that you're able to depreciate when you sell, you can offset a lot of your other income. So, and you're talking about, overall strategy. So, if I'm hearing things right, you could use the depreciation from different assets to keep on offsetting a lot of other income if you're a real estate professional. Now, if you're not a real estate professional, I think there's just a cap to what you can use to offset. Is that right?
Yeah. So now I'll define the real estate professional, very briefly, but again, this is going to be something you want to discuss with your tax advisor. It's someone that you spend more than half your time involved in real estate trade, materially participating in real estate trade or business. So this basically means you cannot have another full-time job. Okay. If you have another full-time job, it's pretty much impossible to get this real estate professional status unless your spouse has a real estate professional status, and then you can use that status against both of your income. And so you have to have 50%, okay, of your time, and like I said, the full-time job, and you have to have 750 hours, which, believe it or not, can actually play against each other. So if you are putting in those hours and your wife or your spouse is a real estate professional, you can actually use those hours that you need to put into the actual participation of the property. Having that status will allow you to use the non-passive deductions. So let me take a step back for a second. Depreciation is a deduction that can only be used against passive income. The passive income is stuff that's from your property. So like I said, if you have a number of properties, they all are considered passive income. You get depreciation deductions, cost segregation, which is creating huge depreciation deductions. You can now take those deductions to offset your passive income. That's income from your properties, okay? There are some other things that could be considered passive income as well. But basically, we're talking about real estate, we're talking about that. However, if you're a real estate professional, you can now use those deductions to offset your non-passive income. So meaning any other income that you have, I would call active income, non-passive, the same thing, right? That means if you're making, your spouse or you're making money from other things, and if you're, you're a broker, let's say you're getting commissions, you're getting all kinds of other income, you can use depreciation to offset that income as well. However, if you're not a real estate professional, and this is where a lot of people get confused, especially when you're investing passively, right? You're not materially participating. You're just a passive investor. You are limited, okay? Those deductions are going to just be used to offset your income from those properties, which means you're going to have, like what you said, a negative K1. You're going to have a negative balance on your income tax. You're going to say you made, let's say $10,000 and you had $20,000 deductions. Those $10,000 are going to be tax-free this year. And the $20,000, the extra $10,000 is just going to create a passive loss. You're not going to lose it. It's going to carry forward. You can use it next year, or the year after, but you're not going to be able to utilize it this year. So you're not going to get the benefits, the main benefits from cost segregation if you are not
Yep.
a active real estate professional.
Right. But the benefits you do get is the income from the real estate is going to be taxed less, or in a lot of cases tax free. You're just not able to offset your active income. So as a broker, I could offset all my commissions, up to all of my commissions, until I completely zero out my taxes if I'm an active real estate professional. As a passive real estate professional, you're saying only your passive income you can get canceled out.
Well, if you're only investing passively, if you happen to be an active real estate professional and also invest passively, right? As long as you have the hours in your active deals, and you're actively, participating in your own properties, then believe it or not, you can actually use the depreciation from passive investments, from syndications, et cetera, and take those tax benefits to offset your income as well. So there is a kind of double standard there that you can you can double dip.
You can
and
leverage.
I know a lot of syndicators that may have, I think I spoke to Dan Hanford recently, a great example, right? He invests in a lot of other syndications as well, right? Not only his own deals, he invests passively in other syndications, partially because he has, money from other businesses that he wants to put in, and he doesn't necessarily want to put it all in one basket. So there's a way to actually get more deductions just by spreading it thin against other syndications.
Now, if somebody wanted to get a cost segregation analysis done, what does that entail?
It's a pretty straightforward process. So if you're working with a company like ours, Madison Specs, we always do a free estimate up front. So you know what you're going into before you even start, okay? So you have the numbers, and we run a conservative estimate, which allows you to see what the potential tax savings are going to be if you do a full cost segregation study versus what would have been my tax depreciation had I just taken it straight line and not done the cost segregation. So you're able to see that up front beforehand. It's pretty, like I said, transparent in that regard. Once you engage a firm like ours, we'll have an engineer come to the property, which actually now we just kind of transitioning into virtual tours as well.
That's right. That's awesome too. I love the idea. So I saw you post that last week, and I was just like, that's amazing. I mean, COVID's actually helped a lot of businesses do things that are just a little different and outside the box. Anyway, sorry for interrupting. Go ahead. Yeah.
No, listen, it's just become almost not feasible. I mean, we did in 2019, we did 2,500 cost seg studies. So to have that volume and keep that up, even with a full staff of 16 engineers, we're not able to travel right now. Travel restriction is still happening. They're only from our main office is in Newark, is in New Jersey. There's like one flight a day out of Newark to random places. If you want to fly from Newark to Phoenix, right, you can't do it. You have to fly from LaGuardia, or there's basically very little flights. So it's becoming very challenging to make that schedule. So we came up with this idea to do it virtually. Taking the necessary measures to do it properly, obviously. Nevertheless, we'll send an engineer, or we'll have the virtual tour. We'll take all the pictures, all the measurements necessary to find all those details that are in the property. And again, we're breaking it down to nuts and bolts, literally. How much of the square footage of carpeting, how many cabinets, every little tiny detail that take that data, we create a report, which is 80, 90, 100 pages long. And in that is extremely detailed, sourcing to the tax code, sourcing to all of the, tax, case history. So, all the history of cost segregation over the past few decades has created more opportunities because different assets have come to light that can be depreciated faster, et cetera. That produces, and really all of this is just mumbo jumbo, because all you really need is a new depreciation schedule. Okay, so that's what you get. You get an updated depreciation schedule instead of your normal depreciation schedule would say what the cost basis is, what this year's depreciation deduction is. Here we break it down after all is said and done, all the calculations. Here's your tax basis, but it's broken down into different categories. Some on a faster rate. This is on a 5-year rate. This is on a 7-year, 15-year rate, et cetera, which allows you to take those numbers, plug them into your tax return.
Yep.
And the other thing that I'll mention, if someone mentioned bonus depreciation, this is a recent tax reform from the Tax Cuts and Jobs Act a couple of years ago, the Trump tax reform allows you up until, right now, until 2023, when it's going to start to phase out, you can actually take all that accelerated depreciation in year number one. So this potentially creates huge, massive tax deductions, which, like I said before, if you're a real estate professional and you need those deductions, it can be extremely beneficial.
All right. Hey, well, thanks for the summary on that one. I'll just tell everybody. So we have 4 multifamily properties right now. Madison Specs, Yonah's company, has done 3 of the 4, and pretty sure since we just closed on the 4th one today, we'll be doing cost seg on that one sometime soon. And pretty sure, Yonah, we'll be calling you first. But let's talk about one thing really quickly. Is there a property that's too small for cost seg? I mean, there is a cost to it. Where do you think, where would you put the line in the sand as far as what's too small to do a cost seg analysis on?
So, there may be different opinions out there. I like to look at it and kind of from just a holistic perspective, meaning it's a percentage, okay? The tax savings are a percentage of your basis. We're not creating deductions out of thin air. What we're doing is we're taking a tax basis. We're saying, how much can you depreciate this property for? How much can we front load? Can we take as accelerated depreciation? And there's a certain number where it's going to make sense for each person on their own, individual basis. My typical rule of thumb, and you can check it. It really depends what type of property, but let's just say multifamily. Under over $500,000 purchase price is going to get you significant tax benefits. Where paying a few $1,000s, like we said, $4,000 or $5,000, makes sense. Okay, there's going to be a 10 times or 20 times return on investment that you're going to get those tax benefits. And again, it's an after-tax benefit, so it's going to be minimal because the purchase price is minimal. Under that, you can look at the numbers, and that's one of the reasons why we run the free estimate beforehand, so you can make the educated decision yourself. Okay, you can see, okay, I'm going to pay this amount of money, and I'm going to get an after-tax benefit of $10,000. Should I pay $5,000? Get it? It doesn't make sense. So the more the property is, the more percentage of that benefit is going to be. So over $1 million is basically a no-brainer.
Yep.
You see the numbers there. Smaller properties, I tend to just steer people away from it because you're just not going to get the benefit. Now, I did have someone literally this week reach out to me. The husband and wife, they're both in investment banking and private equity and making a lot of money. And the wife, they learned about real estate investing. The wife literally, she quit her job at a private equity firm in order, investment banking, and to become a full-time real estate professional so that they can get the tax benefits. And they sent me a bunch of properties that tax bases of $200,000, right? $250,000. I said, there's not a lot of benefit here. You're not really going to get a lot. So listen, I need every single dollar of extra tax deductions I'm going to get. I quit my job to get these tax deductions so we can offset my husband's income. Okay, we're going to do it. So someone who's educated and they understand, the benefit is going to be minimal, then you're going to make that call on your own. That's part of the education.
And that's why that free report is money right there, because you can look it over. You can see exactly what the deductions are going to be. If you have a CPA working for you, you can talk to your CPA, and figure out, how does this fit into my tax strategy? All right, so let's do this. Let's see if we have any specific cost seg questions, and then we'll change subjects to networking online.
Yeah, I see Charles. By the way, Charles, I love your question over here, and I love your very detailed responses on Bigger Pockets. I'm a fan, so nice to see you in person, at least somewhat in person. Yeah, it's a funny question. I don't know if he's a real estate professional, if he's not. I'm sure he's figuring, his accountants are figuring out a way that he's.
They're figuring out the best way to get out of taxes. I mean, guaranteed. And
he's got a full-time job. He can't be.
But he's not getting paid for it. I mean, supposedly, and I've seen pictures of it. But he writes a check back to the Treasury every month. So
it's still a full-time job.
It's still a full-time job. You're right. I'm not sure how that's going to work for him, but I've never really thought about that. I'm actually, you know, when I saw that drop in, it put a smile on my face. Okay. All right. And if
Interesting
anybody's not
question.
seeing the chat room, he says, since Trump's not currently a real estate professional, is he paying more in taxes? So there we go.
Yeah. John asked a good question. John, if you're a full-time assistant or analyst in a real estate investment company where you qualify as a real estate professional, usually not. There are some limitations on that. If you have over 5% ownership in the company, then as long as you're spending those hours and you have somewhat of a, you know, materially participating and you're spending those hours, you may be able to qualify. This is probably a question for your accountant, but if you own properties outright or you have an equity stake in that, as long as more than 5% equity stake, you could still qualify.
Okay.
So I'm going to check into that. I don't really see any other questions.
Most of them I think you've answered while we've gone through it. Okay, you answered the bonus depreciation question. You talked about that a little bit. Somebody asked about entire depreciation of the part you didn't actually use. I think you answered that one.
Yeah, I see Danielle asked the question over here, at what point is it typically done? Is it before closing or after? So that's a good question. And it really depends. So when is going to be the best time? Most people try to take advantage of, especially now with the bonus depreciation, which you can get in the first year. Most people try to get this done, you know, in the first year of ownership.
We closed in December on a property, and the big thing for us is we wanted to get it done before our accountant did our taxes. You know, and so does it have to be done immediately? Not really, but what I'd say about doing it before you close, you never know if you're going to close until you close. I mean, there's always something that happens. So if you get it done before you close, there is a small chance that it's you know, it's a risk.
Yeah, it is a risk. And I literally had someone today reach out to me that he wanted to get it done. He hasn't closed on the property yet. I said, why are you going to pay the money? You may not close. He said, listen, I'm buying a $10 million building. I want to know exactly what my depreciation is going to be. I want to know how my investors' depreciation is going to be. It's worth it. You know, it's like an appraisal. You pay a few $1,000s. It's a risk, but it's part of the, you know, he looked at it as kind of part of the business expenses of the closing costs. Okay, so it might make sense for most people. For some people, it usually doesn't. Again, wait till after you close. But I just touch on one thing. You mentioned, Brian, that you bought in December. Okay, bought a building in December, and you want to, you know, get it done. It needs to be finished before you file taxes. So the actual conservation study does not need to be completed during the tax year that you bought the property. It just needs to be completed before you file taxes. One thing about depreciation, which is really interesting, is that your regular depreciation deduction is prorated. Okay, so it's prorated to the day in the year that you bought the property. So if you bought a property on December 31st, you literally get 1 day of depreciation. So you get 1/365th of what your depreciation deduction would have been, and that's how much you can take. However, with bonus depreciation, you can literally, even if you buy the property on December 31st, you can take the 100% bonus depreciation and take a huge tax deduction that year, even though, you know, your normal depreciation would have been very minuscule. So that's another really cool part about the bonus depreciation.
All right, so let's talk about let's change gears right now and talk about, you know, kind of tips and tricks. And let's say we got about 12 minutes. Talk about tips and tricks on growing businesses on LinkedIn, because I found you on LinkedIn, and, you know, we've done, you know, 3 cost segregations with you, and we'll do more. So what are some things that everybody can do to grow their business or grow their personal brand using LinkedIn? And how would you go about that?
So my biggest advice, and this has been my advice when we did the commercial real estate challenge, right? The 10-day challenge that you talked about at the beginning. My biggest advice is to use social media, number one. So you're meeting people, okay? And that's what it's about. And so when you meet people, you come to an event like this, you go to a networking event, however it is, you're relating with people and you're meeting people. You're not necessarily trying to sell people. Okay? And that's a big mistake a lot of people take. Approach it as a sale and you're trying to like sell people, you're trying to get business out of it, you're not going to be successful. Okay, how you are going to have success, because you know, you're approaching social media like you would any other avenue of sales. If you're taking that approach, which is misusing it. So social media is a great way to build your brand. Building your brand just means people knowing who you are and relating with who you are to what you do. And so if you are present enough, like think about any brand name that you know, you only know that brand name because it's been in front of your face, whether on media or whether, you know, you've used the product, whether you see it. It's in front of your face enough that you see it, it becomes familiar to you, and you recognize what they do, who they are, what they represent. Once you can relate to that, you start to relating to that as, you know, as a person, as, oh, I recognize this person, I know who they are, what they do, and it just becomes, it becomes familiar. So just by knowing people, putting yourself out there and getting to know people just through whether it's providing value on social media, whether it's posting original content, or whether it's just even not posting original content, just being there, right? Like Charles, he's just commenting on, posts in bigger pockets, but he's doing it with intelligent answers, a little wit also, right? It helps because, you recognize, you recognize that and you remember that. And so that's what it's all about.
You know, and something, I mean, Hutch just posted that he's doubled his connections on LinkedIn from one 10-day challenge, you know, and I saw the same thing the first time I did it. But, you know, trying to get to those 18 likes or 18 comments, you know, I think one thing that I realized, exactly like you're saying, is you've got to be genuine and you've got to let your own personality come through. All right. You know, so if you're a guy who likes to joke around, you know, be lighthearted, joke a little bit, but, you know, I think a big part is just that engagement with other people. You know, like you said, Yonah, it's not trying to sell something. It's trying to build a relationship, you know, and if you build a relationship, you know, the sales are going to come. So practical tips on LinkedIn. I mean, what types of posts, you know, do you put in that get a lot of interactions?
So the best posts are, it's important to know what to do and what not to do. And I'm a very big fan of LinkedIn, as you can tell. And if you're not on there, you may not understand this and may not understand the value that's in there, but you'll see posts that get a lot of engagement are ones that add value, right? So again, you're trying to figure out a way, but just in terms of the format, it's pure text, okay? So even no videos, no, not pictures, definitely not links. Never put a link in your actual post. I mean, you can, but you'll see that it will actually make sure that no people will see it.
It just triggers an algorithm. I mean, LinkedIn doesn't want people leaving their page. All right. So you put a link in there, LinkedIn is not going to show it to as many people. And that's why you don't put a link in.
And Facebook is the same way, by the way. So it's important to, you know, if you do want to share a link and you want to share an article to a third-party source, there's a way to do it. I like, you know, pure, not long form articles, because articles get less, but just long form text. So just the actual text, like you're looking through your feed and you see it, and ones that have a call to action. Okay, so either a question or multiple questions or an actual call to action. And it's funny because you might think, well, how can I have a call to action with every single post? You may not, but the ones that do have the most reactions to them. So, you know, I just created a Facebook group today. Yesterday, last week, whatever, and I posted LinkedIn. Anyone want to join this group, right? So you're creating a call to action, and why that helps is because every interaction, every point of contact on that post, triggers the algorithm to push it to more people. Yep. So it's intrinsically, and that's why in the challenge, I urge people to try to get this many likes and this many comments, because the more engagement, the more comments, likes, the more it will actually be pushed out and seen by more and more people. So there's really a wisdom in doing it that way. So the more people see it, the more the more engagement, the more it gets spread exponentially to more and more people. And that's kind of how you get seen by more people and how you build that brand. And so it's all plays into one another.
Yeah. Yeah, one thing I've definitely noticed is just the level of engagement. I mean, you don't just post and let it sit ever. Okay. And I think that's part of the magic formula that you have is every time somebody comments, you're either going to like or comment back. I mean, I don't think I've, commented on any of your posts without, within an hour, even at 2 a.m. for some reason, I think you're doing it within an hour. That's probably not accurate, but, you're either going to like it or you're going to like it and respond to it almost every time. And that also triggers responses. So if your social media platforms are looking for engagement, if they're looking for the number of posts, not the posts, the number of replies, number of likes, and if that's going to trigger their algorithms to show it to more people, one smart thing about that is if you're responding to them, they might respond back too. So if you're just letting your post sit, you might get a bunch of likes and you might get a handful of comments. But if for every comment you make, half the people respond again, you're basically stimulating more conversation, more comments, which means that post is now going to go to more and more and more people.
Yeah,
right?
and it's if you can do it in a way that's not just like a generic comment or whatever. You can do it in a way that actually is creating more value. Creating a question, something thoughtful, instead of just kind of like a canned answer. That's really where the main value is going to be. And I've gotten to know hundreds, thousands of people literally through this process, and it really does work. So one way that you might find, and this is a different challenge that I made, and I actually did one of my podcast episodes. If you want to go to Weiss Advice Podcast, it's called how to add massive value, right? I forget what the title was, but something like that. It's something called the 18 cents challenge. Okay, and this is something which basically the premise is you don't have to post any original content whatsoever. And so this works, perfectly on bigger box and forums like that, but also on LinkedIn and Facebook and other platforms and Instagram and Twitter, whatever, by adding thoughtful comments to other people's posts and strategically to, specific people's posts and specific types of posts where you can be seen by other people. That will actually get you even more exposure to your name, your brand, etc., than it will by posting your own original content. So that's something that's extremely beneficial as well. And I would highly urge anyone to check out my recent podcast or on my profile, the 18 cents challenge it's called.
Okay. Now there's a question in there about what exactly your 10-day challenge is, and someone else said, when's the next one? I think you're in the middle of a 10-day challenge right now, aren't you?
No, not currently.
Okay, maybe I missed them.
It might be a month or so.
A month or so. Okay, so
Yeah,
I mean, 10-day challenge. He gets a group together. He just puts a post somewhere on his LinkedIn. Who wants to be part of the 10-day challenge? DM me, and then he'll create a group. Explain the rules, and the rules are pretty simple. You post once a day for 10 straight days. Okay, weekends not included. Weekends are just bonus time, and you're trying to get to 18 likes and 18 thumbs up, or 18 likes and 18 comments, collectively. And then once you get to that 18 likes, 18 comments, you post the link to your post in the group, and then they all boost it from there. So you're on tap for learning how to get the 18 and 18, but the reward is once you get to the 18 and 18, you put it into the group, everyone in the group sees it, and then they'll all just pile in on it. So, if you're struggling to get 18 and you barely get it, as soon as you put it in the group, you're going to be, 30s and 40s on both of them. So, and what that does, it just brings more and more, recognition to the post, and it gains a lot more steam. Anyway, it's a great challenge. Look for Yonah up on LinkedIn, and beware. I know for a fact he does not accept everybody's request. I think he told me that once. No, I was watching a video that you did, or maybe I don't remember what it was, but do something to engage with him, and he'll accept your request. Is that right?
No, there's more to it. If someone just looks like they don't have a real profile. Like, I don't know who you are. If you look like a normal person and you're, if you're from the United States, I'll almost likely, I don't mean look like a normal person. I mean, like, look, the profile looks normal. Like, you're not just like some, who knows what.
You have a profile picture, first of all. I mean,
Yeah,
I have a
doesn't
hard time
necessarily have
accepting
to be,
people
but
who don't have profile pictures. It's just like,
it's hard.
yeah,
Yeah.
okay. If you don't have it, if you're not taking the time to put a profile picture up, you're probably not going to be on the platform very much, and you're not going to be very engaging. So that's kind of one of my hard and fast rules is no profile picture. I'm hitting the no button. But all right, let's see. Looking at Michael Spencer, he's got a long question. Taking a second to get through this. All right, and Julie,
choice to person.
yeah. While you're reading that, Yoni, Julie Hawley just posted a link to his podcast. So
Yes.
everybody, click that. If you're on your phone, tap it right now, and that way you'll at least open it up, hit the subscribe button, download it, whatever. But there you go.
Leave a review like Brian Briscoe.
Yep,
Thank
I
you very
was
much,
the
Brian.
third one to leave a review. So.
And it happens to be on LinkedIn, just to keep it with the tone of what we're talking about.
Yeah,
yes.
Perfect. Thanks,
Great.
Joy.
Thank you.
Yep. All right.
So Michael, great question about, reposting someone else's post. Reposting someone else's post, for whatever reason, doesn't get a lot of traction on LinkedIn. I don't know why. Using that share button on LinkedIn doesn't get a lot of traction. But linking directly, I don't know why it doesn't. Original content is the best by far. So if you can figure out a way to write something original, it will be better. And if you want to, you can share articles, but don't just share an article and write like one sentence. Like, let's say you go on, Forbes, or you go on, Wall Street Journal or whatever, and you find a great article that's about something that you like. Don't just, click that share button from the post and that's it. Go ahead and write your own review on it, or put some pointers, tag some people that you think might actually find this beneficial. Don't just like share content for the sake of sharing content. Okay, that's really what this is all about. It's about building your brand, about helping to add value, share insights, and by doing that, you come across as someone who is someone that other people might think are intelligent. Other people might want to get to know you, might want to do, have some sort of network, in their network with you. So we all have that. It's just we may not use it in the right way. So that's really what this challenge and what the whole thing is all about. We all have that potential. It's just how do you use it in the right way to give across the right message?
And I'll tell you, I mean, when I first did the first LinkedIn challenge, I probably had about 300 connections on LinkedIn. And I'm hit or miss on LinkedIn. On the 10-day challenges, I post every day, and then I might go a month without posting. But I'm at about 1,800 right now. So 6 times. I'm not quite Grant Cardone. I can't 10 times it, but I multiplied my connections by 6. And it's been about the first one I did was last December. So since December till what is it, June right now, 6 months. I've multiplied my connections by about 6, and that's all just from what I learned from the LinkedIn challenge, and some of it's just learning by hard knocks. I learned up front that putting a good news story up there is going to get a lot of likes, but it's not going to get a lot of engagement. It's really easy to hit the like button when you see something that you like. And short answer questions will get a lot of engagement, but not a lot of like. If somebody just has to type yes or no, it's really quick for them. They can type yes, they can type no, move on. They're probably not going to like it. So what you have to do is something in between, something that makes somebody feel good, aka good news story, add value, and something that people can respond to. So, that's kind of the happy medium that I've found to get engagements, but there are some times where all I want to do is, get a lot of likes, and that's, like when you close on an 80-unit apartment. So, I just noticed, I got the notification. I got my iPad right next to me. Every time I do this, I miss 2 or 3 texts from people saying I don't have the Zoom link, so I make sure to keep it close to me, and I've already passed that out 3 times. But I just saw my partner post on our 80 unit, and I saw the broker post on the 80 unit since we started. So, a couple of, like I said, really good news stories that I hope get a lot of traction there. All right. Well, Yonah, thank you very much. Very much appreciate your time, your knowledge, you know, I think you really brought it today. You know, we learned a lot about, you know, how real estate is very tax friendly, and how cost segregation analysis can really boost your tax savings. And if you're a real estate professional, you know, it's going to offset a lot of your active income as well. And then, you know, a lot of tips and tricks, you know, on how to be more engaging on LinkedIn, which develops relationships, which eventually brings more business. And that really needs to be the focus, is engaging, developing the relationships, and then the business will come, you know. And, you know, once again, you know, I've done 3 cost seg analysis with Madison Specs, you know, because that's what Yonah used. So it worked. He got me hooked. And he never once asked me if he could do a cost seg on our buildings. You know, never once asked. He just engaged, brought value. And when it was time for me to do a cost segregation analysis, it was just like, hey, Yonah, what can you do for me? So
Yeah.